Hi, welcome. I'm Andrew Gaule. This is one of a series of discussions with executives who are leading strategic change, innovation, and venturing. We will hear from them with about an introduction to themselves and their organisation, and we will then be discussing the impact and the mitigation of this pandemic crisis. In the live sessions, we have questions and in-depth discussions with senior peers during this session. We have now edited out those sort of discussions for confidentiality of those participants. The resources and podcasts are available with videos on the Aimava resources website. Please enjoy, make comments, and do get in touch. Thank you. So it's really about helping the CVC community understand what's happening in this big, massive disruption that's sort of come with COVID. So that's the main objective and that with it. And people like yourself, Tony, have been around in this space 20 plus years. And the objective is really to share some stories. And
the REV used to be known as RELX Ventures, hence the REV, is the single LP fund where the single LP is RELX Group. So there's been a few changes of names across the era. So if I can just level set on that, I co-founded this in 2000 with my partner. We were both at the time at SoftBank. The first time that Masayoshi Son was deploying capital kind of globally to create these market leaders and fuel them for rapid international success. And during 2000, we had the dot-com crisis, of course. So it was interesting being an investor at SoftBank as we were beginning to triage that portfolio of what was very aligned with Yahoo and was going to suffer along with Yahoo and what would have some independent legs. And in the midst of that, we came in contact with what was then known as RELX, which has morphed from being largely a print-based publisher of information to a data and analytics market leader globally, operating in multiple verticals, helping professionals and business people make better decisions through the use of data and analytics. So that's been a remarkable journey, and one that actually should be kind of more covered and better written about over that period, because it's one of the few organizations certainly on the FTSE and I think in the global 2000 worldwide that has undergone a fundamental reinvention journey, and that where much of what was of business models and distribution and format has been replaced. So if you look back when I came on board in 2000, roughly 75-80% of the business was print based, which is quite phenomenal when you think now it's less than 10% is print based. And through that period, the rationale for investing as an LP in a single fund was they knew that they were beginning a journey. In those days, it was called to print to electronic migration or print to digital migration. And of course, we knew that was going to go much further than that. But that was the emphasis. And you were thinking there, Jose, about how and when Avon should start to think about how it can get involved with early stage. Well, the shock that RELX had was it was written up at the end of the 90s as a possible early contender to be entirely disintermediated by the internet, and realized that it needed to very, very much more sharply and quickly reinvent. And one of the components of that reinvention was having a better understanding of what was happening and what was coming at it from the private markets. And the way to think about that, and what we talked about with it was, you've got entrepreneurs that are betting their career capital and VCs betting their financial capital on finding ways to disrupt and reinvent the industry before you. And traditional organizations are very much slower to reinvent because they've got existing businesses, existing business models, existing relationships with customers, and of course a talent pool. And new companies can start from scratch on what that new blueprint should look like.
Yeah.
So
Can I chip in there, Tony, as well, just to re-emphasize that? I think it's a very good example there. Reed Elsevier transformed. What I'm seeing at the moment around retail, around fashion, and probably in your area, Jose, beauty, the model is being accelerated now with the decline of the retail high street and the change in delivery and the change with online vloggers and sort of stuff like that. That I think we're probably at this disruption point as well for some of the industries and areas you're in, and re-emphasizing this is a time to be looking outside and that as well, in terms of the entrepreneurs and the tech that's going to be driving this next wave now.
that's right, and
yeah, 100%.
And as we think about that now, if you kind of wind it forward, you think the change that Reed Elsevier was looking at was largely that they felt that a large threat was coming from this technology transfer, from print to digital, the need to re-platform. But actually, over the period, it's become. I think there are three dimensions across that reinvention, which is one is obviously the technology lens, and then the second wave is, of course, the business model and how the business model's changed, partly because of technology, but also partly because consumers or the consumption patterns change. And then finally, which is I think is a very big transformation and reinvention hurdle, which is the talent pools and how the talent pools have the requirements of the talent pool to develop a reinvented business are they're often different kinds of talent. They often live in different places, and often, thirdly, want to work for different companies than the incumbents. And that has been a journey also that I think wasn't quite as obvious in that first period that we were in, where it was clearly a technology and platform. And so when we started really focused on the technology layer. So our first investments were around content replatforming. So things like natural language search, peer-to-peer content networking, unstructured data management, those kinds of things. And then we moved into sort of structured data environments and how structured data was moving things from being kind of the editorialized approach with humans as editors into data, into analytics and derivative data sets that would then be deployed in decision-making environments through workflow solutions that you would be selling as opposed to traditional sort of printed information. So there was a period of time in that early part of the 2000s where the rapid adoption of new content technologies was really changing the expectation of the customers as exactly how they could consume that data. So the publishing handoff used to be extremely high level. It used to be, we have taken all these editors to create some curated set of static information which you can use as reference material. And that as that started to go online, it needed to come to life, and it needed to be much more a movable lens on movable data types. So you have now these days you have the notion of real-time data kind of extracted at source from sensors and sense-making equipment that now needs to be passed up into a kind of a movable lens AI and machine learning environment that delivers automated insight from the pattern recognition and from the instruction set that the logical environment's got, as well as enabling humans to make better decisions. So kind of where we've moved very quickly to in the last 20 years is away from sort of static information in static environments that is human curated to machine generated high throughput augmented intelligence and augmented interface environments where the humans are being supercharged by the environment, not just from the information. And that's kind of the era that we're now in. So that was the sort of foundational principle of that. So when we started, we were seeded with a $100 million fund, and we started to invest in content enabling technologies. And our focus at that time was mostly in the US. So our US portfolio started to build quite dramatically. And we actually had less investments here in the UK and across Europe. Where we are now, we've got sort of just less than 50 investments worldwide we've made over that period. We've got roughly 17 now that are still active. We've sold the majority of those. We've listed one, sold the majority of those we've only had 4 that have gone genuinely out of business, which we're actually quite proud of. 90% of the portfolio has been in the United States, half of that in Silicon Valley, the rest dotted around the US, a couple in Boston, New York, Seattle, Los Angeles, Midwest, outside the US in Tel Aviv, Berlin, London, and actually one in Perth, Australia, of all places. So we actually have a very kind of wide footprint of locations and a very broad waterfront of sectors that we look at, because 2/3 of what we are typically investing in are in these sort of vertical reinvention plays. So things like in healthcare, in legal, in education. We've done stuff in finance, agriculture, and 1/3 of what we've done is in horizontal technologies, where you're building a new data platform, new analytic environment, using AI and machine learning as tools. So that's how we think about our portfolio. Over those years, we've managed to make money in each part of those, that equation, such that where we are now this is and has been for some time a fully self-perpetuating profitable fund, in that it effectively is free to RELX because of the distributions that we've made from the successful exits that we've had, and we've still got just under half the portfolio still active. So we're very kind of pleased with that. And along the way, we've been fortunate enough to get into some category leaders. So in the early part of the portfolio, we got into some things which were early movers in content replatforming, such as Insight, which we sold to Business Objects, or SRD, which became the threat and fraud detection division of IBM, Cyperion, which was sold to Informatica, so Netley, which was sold to Akamai, which was application delivery, and then we met Palantir at a very early stage. So we're one of the earliest investors in Palantir, which of course is coming to the fore at the moment as it's the platform of choice to understand how to better allocate resources during the COVID epidemic in healthcare, national healthcare environments throughout the world. And then more recently, we've invested in some category leaders such as Babel for language learning, and Recorded Future for cyber threat intelligence, which we successfully sold actually to Insight Partners last year for just under $800 million in a few short years, showing how good both cyber is as a category, and also how relevant it is. But also showing the superb execution of Chris and his team at Recorded Future. So there's 2 partners, and has been since the beginning, the 2 core partners, and we've made all the investments between the 2 of us. So we're actually a very stable team. We always say to entrepreneurs, who you see is who you get. Our career is as venture investors. We are neither of us looking to take a role in the corporate host. And I think what really played into that for us is the structure that we have at REV. From day one, we have been a single LP GP fund. So we pay carry interest. We invest in 10+2 year long-term funds. So we have a series of Delaware limited partnerships. So it comes onto our balance sheet, and then from our balance sheet into our companies, and we account on a partnership basis. So we don't make a profit and therefore distributable returns until we've paid back the capital, the preferred return, and the management fee costs of running the entire ventures program. And so we are a VC for all intents and purposes with a single LP. And we chose that structure from the very beginning purposely. And Reed Elsevier, as it then was, or RELX as it is now, were very forward thinking back in 2000 to recognize that the best way to recognize with us that the best way to operate anything that was working with entrepreneurs and other investors was to be symbiotic with them, and to have the same alignment, the alignment with them with the same compensation profile. So our long-term compensation comes from making money from the portfolio, which in turn comes from supporting entrepreneurs to be as successful as they possibly can. So we're entirely aligned with the other investors and the management teams as they build their businesses, and particularly the entrepreneurs. And from day one, having that structure put us into a completely different category as an investor with a corporate ownership to every other corporate, what you might call corporate fund of that era, and indeed this era. I mean, there's very few still corporate funds that have got the LPGP structure, and it removes in those days anyway, where there were a lot of corporate investors that got into the market, got out, got in, got out. It removed all those questions from the table from entrepreneurs as we first got to meet them.
Yeah, I'd like to re-emphasize that and agree with that, Tony, because the model of having an annual budget or having a 2 or 3 years budget from a corporate of we're going to do this investing, I think doesn't give that sort of commitment. And we've seen about 200 corporates per year coming into doing corporate venture capital is the sort of stats from GCV and from CB Insights, and a massive percentage of them are going to just drop out, and they don't survive more than 2 or 3 years because the corporate patience and that misalignment and all the stuff you've just talked about, just re-emphasizing that is so important.
And we found that has been really beneficial to ensuring that we as a partnership have got a very long-term view on this, and two, that we can hire very good talent in as associates and principals into the fund, because they understand they're working in the venture industry. They're not this is not part of a career path into any part of RELX, and that's a very different approach that we have, I think, to many other corporately sponsored funds. But it does make it very clear and crisp as to, one, what we do, two, how we get compensated, and three, where our allegiances lie. Our allegiances are to ensure that our portfolio is the very best it possibly can be. Now, the way we square that, because this is the question that people ask, is how do you balance strategic and financial? That's always the big question. Well, how we do that is we think of VCs as spending roughly a third of their time fundraising, which is a relatively low value add approach. You have a pitch deck, you go around, you tell them the returns and so on. What we do is we spend that equivalent amount of time, which is roughly 3 out of every 10 hours, in strategic dialogue across RELX Group. So in individual operating units, at business unit level, at divisional level, and at the corporate level, in a range of activities. It could be strategic planning, where we'll have done a bit of work on market mapping and sort of looking at where money is flowing and the kind of technologies, business models, and talent pool shifts that are going on in a particular space. It may well be we've picked out some long-term trends, which we do periodically. We've done that 4 or 5 times over that era. A few years back, we did something called the Anatomy of a Digital Native, where we did a full analysis of how incumbents are being massively threatened and dislodged by insurgents across 9 dimensions. Of the three big ones being sort of data under park, and the analytic layer, and the change of business models. And we drove out a whole lot of case studies using our associates to demonstrate how traditional businesses were being massively challenged and outgunned and outplayed by insurgents into their markets. And that was a higher level strategic involvement, where we took that across each of the main divisions and down into the operating units. And so that's one end of the spectrum we do. And the other end of the spectrum is being very responsive to individual requests that come out of business units. You can imagine in a group the size of RELX, you've got 32,000 people worldwide working across multiple markets. So you've got legal, you've got science, you've got banking, you have insurance, you have aviation, you have agriculture, and there's even a very big exhibitions group, and there's a big kind of health markets group which operates kind of worldwide there. So you're covering multiple important verticals, and they are a data and analytics provider to those verticals. So they're providing in real-time information in the case of risk, of background profiles and entry exit and anti-money laundering. Or in the case of Elsevier, what they're doing is they have a huge number of primary scientific journals, as well as an index of all the journals that are out there, and the ability to help governments understand their spend and return on scientific study and expenditure. You have legal, where they advise, they help lawyers better, run their practices by providing precedent information and deep legal research around litigation and practical law advice and those kinds of things. So they're kind of very deep in their markets. And we'll get inbound requests across all of those markets about, companies that they've seen. Have we seen them? What's our take on these markets? How would we respond if we're on the board of these companies? We get very tactical questions along the way as well. And what we do is we wrap that whole thing up into sort of the availability to hopefully add value through our insight of understanding how entrepreneurs work, how funding works, and how the VC world is operating, and where that market is going, and quite how they're looking to disrupt. What we don't do is ever share individual company information. We're not trying to be kind of a spy on the world or anything like that. We never share any company information unless we're asked to pass on a piece of information from a company that wants to get to know one of the operating units. What we're doing is we're trying to extract the data and the analysis from looking at a broad number of industries with a huge number of companies per year, 2,000 or 3,000 per year. And so we're trying to flip the model, because there's a model of venture investing from corporates. It says we're going to invest in one or two great companies that are going to change the way our corporate host works. We're going to find the needles in the haystack, the silver bullet, and that's going to we're going to suddenly find the answer. What we did is we recognized that was a very, very long shot in any industry. It was a long shot in venture industry to find a successful company in the first place, let alone one that's going to be both successful and transformative to the corporate host. Then you're kind of beginning to narrow down to an N of, in the nano region of all the companies you're as a percentage of all the companies you're ever going to meet. So we flip that model. So say, we're going to look at 2,000 or 3,000 companies a year. We can understand how that's shaping markets. We can understand individually by market how they compare. We can see how much money's going in. We can look at the kind of how users are changing their expectations. We can look at how business models are changing, how talent pools are shifting. There's a number of dimensions on which RELX needed to reinvent. Only one of which was technology, as I mentioned at the beginning. The others around business model, user experience, and those kinds of things. So I'll give you a great example of that. In the early part of the portfolio, some of the things that we were seeing was how users were wanting to consume data and information in a completely different way than the editorialized function, and in particular where you had any kind of data that was in electronic format, the way you'd search it was through Boolean algebra, Boolean expressions, which these days I don't think even people know what they are. But it's sort of figuring out which data set to use and what question to ask of which data set. And we said, well, no, the world is moving like a Google interface. People are just going to want to go into one simple interface and access the information. So that was a piece of information that came out of understanding not just obviously Google, but all the new entrants to all those markets had sort of these single one-line interfaces to their quite complex knowledge infrastructures, and it took a long time for the traditional professional information companies to catch up to that, because they had got professional customers using Boolean search and those kinds of things. So there are a number of things that you can extract as you kind of invert that pyramid and you look at all these companies. You can start to join the dots on user experience. You can look at funding models. You can look at business models. You can look at kind of the talent pools, how you extract the right leadership, how you incent the right people. And all of those are the kinds of learnings that are just as useful when you're talking to how a business unit of RELX needs to reinvent. In fact, they're more useful because you're giving tools and examples and case studies of how organizations have operated versus needing to buy this company or buy that company to make the success. So that's how we kind of inverted that model over the years, and that's how we work with RELX and have continued to work with RELX over those years on that 3 out of 10 hours model and periodically raising new funding from them and showing them real financial returns, so that we became a profitable unit within RELX, whilst delivering the kind of advice coming and insight from the private market you couldn't get any other way. You couldn't get that from bankers. You certainly couldn't get that from consultants, and you could only get that from operating within the context of the entrepreneur's environment.
Tony, could we move on to now post-COVID? The world is from 2020, or when you set up, so from 2000 when you set up to the end of last year, was, you had the dot-com crisis, you've had 9/11, you've had the financial crisis. We're now in another phenomenal one, which is like 9/11 and a financial crisis, as I sort of put it, happening in every country in every month, going sort of forward. I think we can sort of see at the moment. So what's your experience at the moment with the ventures that you've invested in and the triage in them?
Yeah, absolutely. I mean, I think we put in the notes of this that there are kind of three main buckets I would group this in. The first one is managing the LP, which I think is very important for any venture fund during this kind of period. They need to know how you're thinking about capital allocation and what to expect during that period. The second thing is how you are thinking yourselves about the investments in the portfolio and what their capital needs are going to be. And then thirdly is how you enact those involvement with those companies. And I think those are sort of three different layers, but all sort of caught in the same conundrum. And before you kind of can do anything, I think in these periods, you have to sort of, as a partnership group and as a team, recognize that those are the three main issues that you're going to be wrestling with in order to stabilize the base. And until you've stabilized the base and understood kind of what your house response is going to be, it's then very hard to do anything more than that. It's hard to do much origination. It's hard to do how you're going to manage the portfolio. So if I break those three things down, and I think this kind of depends on your relationship with your LP, and we have maybe a different experience set to some others, because we have been with the same LP for 20 years, and we are a very well understood entity. And if I think of Jose, where you are, you're thinking of how you're going to create something. So I think you have to sort of think about what relationship you have and what expectations they would have going in. So for us, I think that piece was a relatively quick exercise, because I think we've been through a few downturns with our LP, and they've seen how we've responded, and we've seen how they've responded. And RELX, we're fortunate with RELX it's a very well-run, thoughtful entity that understands really how to invest over the long haul. And so we've had good conversation with them about what this period will mean in terms of how we're going to operate. So we've actually more focused on how we're thinking about capital allocation with them, rather than talking through what it's going to be like to go through a downturn, because we've got to really do understand how that's going to affect them. And they've been making various releases to the the announcements to the public market over the last few weeks about that. So if I move on to how we're thinking about the portfolio, we very early on, probably about a month and a half ago now, we started to see that we were coming into a difficult time, and we started to look across across the portfolio. And really the main thing is, as I'm sure you all know, is looking at the cash needs of the portfolio. And that's really taking a no holds bar approach to each of the portfolio companies, thinking about how much capital they're going to need for the year, what their plan going into the year was, how that plan will need to change, and then touching base regularly with those companies to make sure that you get a good understanding of how that view is evolving. And that sort of comes into that third bucket there, which is why this is interrelated, which is how you interact with your companies. And I think probably the easiest way to get to how you manage your portfolio is to think first about how you manage with each of your companies. And you've probably got one of three relationships with a company. Either you're a board director, a board observer, or you're an investor without either of those former two rights. If you're a board director, and I know you've got Neil on next week talking about a director's responsibilities, but you do have some very strong and clearly demarcated responsibilities around fiduciary duty and duty of care, which you need to be really focused on with those companies as you're thinking through your response as a fund. And sometimes your response as a fund is going to need to be different to how your response as a director will be. And, And this comes in, and I'm sure you'll touch on that a lot next week. So I don't really want to presage anything or steal any thunder. But there could be circumstances in which what needs to happen as a board member, you're not you know that it's not going to be at top of the list as an investor for you to be doing. And I think that can, in these periods of time, cause tremendous stress and tension, particularly if the way that in which you define the corporate fund is more strategic than the way we are. So for us, it's the way we resolve that is very straightforward. We're always on the side of our companies. Our whole structure is as a venture investor, so we are constantly always only thinking about our role in the company is to do best for all shareholders. So that's why I say you come back to kind of some of your structural decisions early on in how you set the stall out for your venture program will I think have a big impact on how you are able to behave with your companies during this process. So
yeah, I think I agree. That's a really good important point, just to re-emphasize that behavior of you being on the board, you being the GP of that fund, and then the investor being sort of arm's length. It gets very muddled when corporates are just investing off the balance sheet from a budget, and especially if the person that's on that fund sort of side has come from a corporate background, not the sort of depth of experience you've got with, you saying you're a VC. And I think that's a really important sort of distinction, to think that, it's okay just to change your hat. And, the image we're going to be discussing next week with Neil, we've got this sort of head office image, and we've got the image with the startup, and the person on the board has sort of got their legs split across these sort of two areas. And I think it's really important, as you sort of say, your image is you're sitting around the table with that startup, rather than having to think about what your employer at head office is saying. So I think we shouldn't. That's why I wanted to re-emphasize that. I think it's a really good point you make there.
Yeah, and that's why I don't want to take anything from Neil's talk next week, but it is that the most important thing to consider as you go through this is you've invested in usually the entrepreneur's only got this in their portfolio. You've got many other companies in their portfolio, and you need to be very sensitive to what is happening in that company, because that company will live or die based upon some of the decisions, potentially the decisions that are made over the next 3 to 6 months of a downturn.
Yeah.
And you've got those. So I think it does change across those three roles of investor to board member, with the observer being this sort of nasty. I always think the observer is a bit of a nasty halfway house, but as an investor, just a pure investor, you have no fiduciary or duty of care obligations. So technically you could respond very differently. But what I would say is all the VC community would echo this, is your reputation as a VC is more made during a downturn than it is when things are going very well. Because what people want to know is, how do you respond when things get rough? It's very easy to respond well when things are going well, when all boats are rising. It's very different than when the hard decisions have to be taken. And when the hard decisions have to be taken, the entrepreneur wants to know, are you with them? Are you in the parlance of fellow traveler? Are you looking to find solutions? Are you helping the company, or are you Are you being difficult? Are you punting an agenda that nobody else can see? Are you on the side of the entrepreneurs? Well, also, where it comes down to, on the side of the company rather than the entrepreneur, I should say. So
Yeah.
I would say that during this period, as you're working with your companies, your reputation will either be enhanced or challenged, and you used to have that at the back of your mind. It doesn't mean to say you do exactly what the CEO says or what other investor director says. What you do is you make the choices that are right at the time, balancing all of the inputs that are right for the shareholders, that are right for the company and the stakeholders as broadly, and not one individual agenda. And if you follow that, then you're on the right track. So I think that's the interaction you want with your companies very early on, and then as a portfolio, then that's where you could have some different conversations, because you're going to go across. The whole point of triage is to understand where the problems lie in the portfolio, and you'll probably end up, as you triage a portfolio, you'll have those that will weather the storm or thrive. And as we're finding in our portfolio, we've got a few companies that are very well exposed to e-learning and remote working and those kinds of things. And there's suddenly an uplift in demand for those companies. I'm sure that will come off once COVID's over, and that'll be its own problem. And you've got other companies at the other end of the spectrum in any portfolio that will require some more cash to get through it. So as you triage, you need to really think about which bucket these companies are going in, and then how you are going to respond, and be very clear in how you are going to respond, and be honest and real with each other about what that's going to mean in terms of time, in terms of capital, and in terms of supporting the company through potentially some pivots in pricing and strategy and those kinds of things.
And you are going out doing origination of looking for new investments. That's going to be quite a shark fest or a thing in that at the moment. Tony, what's your view on doing origination in the current base, if you're coming in without knowing a bit of background about the entrepreneurs you might be investing in, a bit more about their track record, or who else you're going to be investing alongside? It's a bit of a challenge coming in at this origination stage, wouldn't you say? Even though deals might be great and talent might be available now.
Yeah, I think there's a couple of components to that. I think it's a very good point, actually, because I think on a chemistry level, you need to have met the team if you're going to back the team as a VC. And I don't think that is going to suddenly shift to a 100% online meeting. Yeah. And so if, as an investor, you haven't spent time face-to-face with not just the entrepreneur, but the team, I don't think those deals are going to get done. Now, that will therefore mean a number of things. Maybe there's an opportunity within a social distancing regime to do that. If you're a local investor, I think that can happen, and undoubtedly that's what will happen for more kind of maybe earlier stage local investing in particular. And Silicon Valley, everyone is in kind of similar place. Yeah. And you can imagine that people can get together. I think where it becomes much harder, and definitely for funds like ours, where we are typically investing in cities that we don't live in, that creates a blockage naturally. And I think a lot of corporates are in that situation. And indeed, these days, a lot of funds are in that situation. Yeah. And then I think, so that there's a very sort of human chemistry component. So I'd put that into, if you haven't already met the teams and already know them and already know the entrepreneurs, I think that's a big challenge to origination in this market. Now, what you can do is you can fill the top of the pipeline. So you can do a lot of meet and greet, which is what I'm doing. I'm still seeing the same number of folk at the top of the pipe. There's at some point you can't move to that stage where you say, right, well, we're gonna meet and get together. But there's a second problem at the moment, and that's we're just coming into the tumbler. At the end of last year, we're at the end of a very big bull run. It was a very frothy market. You'd have to pay up. The question was, how many quarters ahead of the performance are you really going to pay for? the rules of the game around what SaaS multiples were. They weren't a range, but you kind of knew what they were.
Mm-hmm.
Even coming into the first part of Q1, you were there. Right now, I think that is up in the air. How do you value a company during this crisis? And it's not a question of how you get value. It's like, where do you peg it? Is it going to get worse? Is it going to get better? Is it going to get better then worse? Is it going to get worse then better? It's that whole curve thing.
Yeah.
And I think you add that component of how you're going to price it and how you're going to get comfortable with the risk. So, as you're looking at pipelines and moving off to the right, if you're talking about selling $100,000 plus software, it's definitely taking a lot longer for the same reason, because to originate in software sales, often technical teams have got to get together and those kinds of things. So there's some complication there, and I think right now, as we're talking, kind of in April, is about probably the worst month, because it's all kind of happening around us. We're not sure when stuff is going to get unlocked. We're not sure how different states in the US and how different countries in Europe are going to respond. We're not sure whether this is going to be 2 months more, 3 months more, 6 months more. So I think there's a lot of uncertainty. I suspect as we go through and this sort of settles down, then that sort of deal making pricing component of it might become clearer. As the markets settle in. I mean, we've seen the volatility in the public markets. We've got the same volatility in private markets, and the same thing's happening with M&A. So I think, as far as I can tell, those things that were already in process with bona fide high quality funds have closed on the terms that were negotiated before the crisis. I think the harder thing is establishing the basis of terms over the next few months is going to be a lot harder. So those two things are going to be a natural elongation to the origination cycle, and perhaps even full delay.
Yeah. Another layer I'd put on top of your origination point. There's that personal contact with the team, but in your experiences, you probably heard about that entrepreneur or that person 6 months ago because they were pitching at some other event, but it was a bit too early. And also the other dynamic, I think, is that you've been around this space for some time. So the people you've invested with in Seattle and Silicon Valley for some time. So if one of them contacts you and says, oh, look, there's a guy in my backyard now who's really good, and they're doing a bit of a down round, or they're ready to take off in this bit, you will have that conversation with them. And if you're coming in new to this, you haven't got that ecosystem of, have I done a deal with these guys before? Or have I not done a deal with them, but I like them and I trust them, and if they're going to bring me something in, to put into the top of my hopper, I will spend some time looking at it. I think there's that as well. I think corporates who are new to this don't understand, because they come at it from I'm just going to get another supplier and I'll just put them through this churn that I do when I'm getting a supplier or a consultant.
Of course, that last point, I think that venture investments and venture origination is not the same as supplier origination.
Tony, we really appreciate your insights and perspective you've given with this.
Thank you for joining us, and do subscribe to the podcasts or to the videos and look at Aimava resources. Feel free to drop us an email or a message and be very happy to follow up. Thank you.